Bank of America is the nation's second largest bank. It serves 1 out of every 2 households in the United States, and that gives it pretty unique insight into the state of the consumer. Joining us right now in a CNBC exclusive interview is Brian Moynihan. He is the Bank of America's CEO. And Brian, thank you for being with us this morning.
It's great to be here, Becky. Good to see you again.
All right, let's talk a little bit about what you're seeing. We've been talking for a while about what's happening with the market. Part of the concern maybe is changing policy coming out of the White House. But there have been real concerns about what's happening with the consumer confidence. Some of the retailers and the airlines talking about how they're seeing some weakness, at least for the month of February, they were with the consumer. We wanted to hear from you because you have such a good feel for the pulse of the consumer, what you see happening out there.
So, Becky, I had them go and pull the information just as the most recent date they could get, so they got it through Monday. And if you look year to date, our Bank of America consumers are putting 6% more money, into the economy than they did for the first 2.5 months of last year, and that's a pickup from the fourth quarter last year, which ran 4.5%. So that money is going to different places, and you've reference some clients who might be seeing different things, but a lot on services, a lot in entertainment, but the spending levels continue to go up. And so we're in this classic moment, which we've been in various times, as you and I have talked over the last few years, where the consumer is saying, I'm getting more pessimistic in some of the surveys and things like that. But if you actually look what they're doing day to day, they continue to spend, which means the economy ought to be holding up better than people think. And so we'll see this play out. But right now, the consumer is spending about at a faster rate now than they did in the fourth quarter and a faster rate than they did last year, and that money is going out in the economy every day. And that for a year, that amount of money going out of our accounts is $4.5 trillion. So it's not a small sample set, and it's going into all different places.
Is your point then that the ones we've heard it from, the retailers, the airlines, I mean, they're just spending it on different things?
Yeah, they're shifting to services. Entertainment, eating out's been relatively stable. They may not be buying as many airline tickets. That you look at a debit and credit card data, you can see that. But at the end of the day, what I'm talking about is this quarter, $1.5 trillion will go out of our consumers' accounts in the economy. It's going 6% more will go out this quarter than last year, round numbers. And that means it's solid. And I think that sets up what Candace Browning-Platt and her team see in the research is they don't see a recession, but they continue to consider the tariff impact on GDP, and they'll keep reflecting that, but they don't see recession. They see inflation being sticky, and the Fed's going to hold rates, and we can talk about that. But that consumer-led economy that the U.S. is, that spending level, and this is what is going on, not what people project will go on. And there's great debate about that because a lot of people say this could happen or should happen or might happen. This is what they're doing so far this year.
I guess the question becomes, is it a self-fulfilling prophecy once you start to see consumer weakness, just in terms of consumer sentiment?
Well, if you think about, think of COVID and think of after COVID and think of different policies and different things going on, the stopping of the stimulus payments, you've seen the consumer confidence up and down. And I think the consumer is rightfully saying, wait, these things may cause me to have to pay more, so let me think about that. Rates are up, and it affects car loan pricing. It affects mortgage pricing, and that has an impact. But on the other hand, the consumers have tremendous wealth built up in their homes, as you've been reporting. Your team's been reporting. It's the highest it's ever been and growing. And the stock market has corrected, as you just referenced. But the reality is we're out where we are in September, and the consumer confidence in September was pretty strong. So this will sort out, and I think a lot of it has to do with the amount of changes going on with the new administration and trying to sort that out both for the consumers and companies and small businesses.
Let's talk very quickly about the Fed, that meeting coming later today. You just said that inflation has been very sticky. I think the market's trying to suss out whether the Fed would step in if we did see a dip in the economy, or whether they'd be more likely to worry about inflation as we see it right now, not being completely back to their 2% target, and any potential inflation that could come from tariffs. Where do you think the Fed is going to be putting more of its focus?
Well, so let's go back to what the broad outlines. The Fed's going to reflect what they see in the stats and the data. They've been clear about that. If you look at what our team sees and what they project. They project the U.S. economy to slow down this year from a high 2% growth rate to closer to 2%. And the tariffs, they think, are about a 40 basis point hit to growth, especially in the first part of the year as people adjust to them. And so right now they have 2.5% for the first 2 quarters of this year. My guess is as those tariffs become more real as we move to the April 2nd date, et cetera, they'll bring that down a bit and probably closer to 2 for the year. And I have 2% GDP growth for 26. That's trend growth. That's what we've all been trying to get to for 10 or 15 years after the financial crisis. We never saw that kind of GDP growth rate except in corrective periods, and we never saw inflation. And on the other hand, inflation is stickier largely because the tariffs add to inflation. They believe that, but they think it's handleable and offset by deregulation and other things that businesses will like, and that will help profit margins be maintained and maybe not pass through everything to customer. But once you get through the other period, it'll adjust out. But they're saying that adds to inflation, so that means the Fed's probably on hold for the rest of their quote forecast period, which is the rest of this year into next year.